I'm Charlotte McLeod with the Investing News Network, and here today with me is David Talbot, Managing Director and Head of Research at Red Cloud. A little background on David: he's a geologist and he worked in the gold industry for 10 years at Placer Dome, Franco-Nevada, and Newmont Capital. He entered the sell side in 2003 and spent 18 years working at Dundee and 8 Capital. He joined Red Cloud just a little over a year ago. David, thank you so much for joining me online today. Great to see you.
Thank you very much, Charlotte. It's a pleasure to talk with you today.
Yeah, we've got an exciting discussion ahead. And before we jump into our conversation on uranium, I want to talk a little bit about Red Cloud's upcoming very pre-PDAC mining showcase, which runs from March 2nd to the 4th. Before we get started, can you run through what the event will look like and how investors can tune in?
Certainly, Charlotte. So Red Cloud's very pre-PDAC mining showcase will be our largest virtual conference yet. We have over 109 company speakers, 4 keynote speakers. Investors can go to redcloudfs.com for free registration. We already have about 1,000 lined up for this event. And I do want to point out the Uranium and Battery Metal Day, which is Wednesday, March 2nd. And for this crowd that we're talking to today about with uranium investors, we want them to be aware that our keynote speakers, Anna Brinza, who is UXC's EVP International. So she's already claimed that 2022, this year, would be the year of geopolitical upheaval. She's from the Ukraine herself. I think she'll have some excellent insight into what the current events in Europe might mean for security of supply for uranium.
Okay, yeah, so this will be a great event for everybody to tune into, some very topical discussions. And now moving on to our topic of discussion today, which, as we mentioned, is uranium. I want to get your thoughts first on the demand side. So looking back to the second half of 2021, there was a lot of excitement about the entrance of the Sprott Physical Uranium Trust. I'm sure we can all remember that. Buying seems to have picked up again recently. So I was hoping you could give me an update on what we've seen from the Sprott Trust lately and the role that this vehicle plays in the market, especially right now.
Certainly. Now, we just wrote on this topic earlier this week, and one cannot ignore the impact that physical uranium buying had on uranium prices in 2021. Prices rose about 35% to $40 a pound by year end. Key to this was about the $1.3 billion that Sprott raised last year, going on to purchase about 21.5 million pounds to hold about 40 million pounds by the end of the year. Now, we are seeing prices rise again this year. They're currently at about $47 a pound. Specifically, uranium prices are up 9% or $3.75 a pound over the last 2 days last week. Now, it does seem apparent that many investors believe this Russian-Ukrainian situation will lead to higher uranium prices. That said, I don't think there is a lot of risk premium built into the current spot price. The price appreciation looks to be more a response to Sprott buying. Now, Sprott reportedly has raised about $100 million in the last couple trading days. That's enough to buy over 2 million pounds of uranium. It is approved to raise another $2 billion. So we see there's a lot of potential to go out and take another chunk of physical out of this market. For investors, specifically large investors, the large cap trust might be the only way to play the sector for them. And for industry and investors, this might be the best way to see a transparent uranium price as opposed to depending on the latest spot trade.
Okay, so thank you for that. We all know, I think, that utilities are another important part of the uranium demand story. And I've been hearing for quite some time that it's only a matter of time before they start contracting again. But as we know, it can be difficult to get a clear idea of what they're doing. So I wondered if you could now talk about the utilities space and what we may see there as 2022 continues.
Okay, you're right. The resumption of contracting is very important to sustaining uranium prices. This is the term market, not the spot market, that really becomes important here. And at about 10 million pounds traded in the spot market year to date, dominated by physical buying. At this time last year, spot trading levels were just 5.6 million pounds. So this was just this thing started to tick up with such as Kazatomprom going out and buying to deliver physical to Yellow Cake. And then we saw a flurry of uranium company buying. That was a unique development in the space. And all of that was about 6 months before Sprott started buying. But this what we want to talk about is the long-term contracting of the term market. The term volumes are certainly up, and this is important. This is what we want. Last year, we saw only about 8 million pounds of term volume by the end of the first quarter, and that represented about 1/3 of all trading. Year to date, we have already seen about 50 million pounds traded in the term market, and that represents about 80% of all trading, uranium trading. So this is possibly a high since the early 2000s. Much of it might be coming from Cameco as well. So at 50 million pounds year to date, we might also be on pace for utilities to replace the 177 million pounds of uranium that is used by reactors on an annual basis. Now, we'll see, but certainly over the past several weeks, as geopolitical issues are creating some uncertainty, we are seeing some utilities enter the market. I do believe that US utilities are more interested in supply and less sensitive to price, partly because some utilities can pass on the cost to customers. But that said, utilities don't like price volatility, especially when it's coupled with inflation that we are seeing. So, I'd say over the past year or so, US contracting does appear to be approaching its 50 million pound level per year. This is more, there is more contracting this year. We're just not yet at those 2007 levels.
Okay, and as we continue to walk through the demand side, we have Japanese reactor restarts, which some people believe are going to be a key catalyst. I wonder if you could share your thoughts there and on any other parts of the demand picture that we have not covered yet.
Yeah, I do believe Japan is an important indicator of the health of the nuclear industry. I don't look to Japan as being a demand center anytime soon. They really still aren't buying, but they are taking delivery of previous orders. The Japanese didn't sell back to the market after Fukushima, so they should have fairly extensive stockpiles. However, Japan does remain committed to the nuclear program as part of its energy mix. Currently, it's about 6% of Japanese electricity, but targets for 2030 remain about 22% of the mix there. So what's notable, I guess, is that there's about 10 of 33 active nuclear power plants have received clearance to start. And to get to those 2030 goals, we're probably going to need another 10 reactor restarts.
Okay, so let's head on over now to the supply side. And I think a good place to start with that is current events. You've been alluding to the situation between Russia and Ukraine, which is, of course, developing quickly, but we're going to try to address that. So that has the potential to impact the uranium market. And I wondered if you could just outline the key factors for us to watch there.
Yeah, so this Russian-Ukraine situation is really fluctuating daily here. As we said before, US utilities really concerned about security of supply. We believe that investors also expect uranium prices to rise based on this geopolitical uncertainty. 8% of the US electricity is generated by Russian, Kazakh, and Uzbek source uranium. Now, while the invasion of Ukraine doesn't necessarily impact the renewed Russian suspension agreement that set limits on the amount of uranium that can be delivered into the US, there is potential that Russia does cut off deliveries should sanctions get even more strict than we are seeing. That agreement calls for about 6.2 million pounds to be delivered into the US this year, again, the same amount next year, before declining to about, I'd say, 3.5 million pounds thereafter. Now, we don't see any immediate disruption from uranium deliveries into the US or to Europe, but certainly that might change. And we don't expect any halts from Kazakhstan, which is the world's #1 producer. A way to get around this a little bit, the US Treasury Department has informed US utilities that purchase energy products, including uranium, that they can apply for licenses to do business with sanctioned banks. Of course, this was before Russia's ability to use SWIFT was also removed. So I think payments for deliveries now is becoming the big concern. And, that doesn't consider whether Russia will want to supply uranium or enrichment services to the West. I do think the West will think twice before they sign contracts with 10X or the Russians for a while, but we will see. We speculate we might need some additional supply from senior producers, Cameco, Orano, Kazatomprom, for example. But probably a little bit more important than even uranium supply is that Russia supplies 20% of the enrichment needs for both the US and the EU. And that can be much harder to replace than the uranium. You look back a few years to that Section 232 review on the American nuclear industry. That was started by two uranium companies. They foresaw this risk, and I think the government got it at that point. Longer term, this whole episode, let's call it, could even be positive for nuclear power. Yes, there are some scares about Chernobyl occupation right now. We've heard that a couple spent fuel facilities have been damaged, and there are nuclear weapon threats. So, negative news may impact sentiment. We saw that at Fukushima, but we have seen mixed results today. Hungary did impose sanctions on Russia, but plans to keep building a Russian-backed reactor. Finland has placed its reactor under construction on hold for now. So we will see. But I think the key to think about here is that the EU is now being pinched with respect to natural gas supply from Russia. And we could see energy security become paramount. So some countries might further expand into nuclear, reduce reliance on natural gas. I don't really think Germany's going to do an about face right now. It did a 180 right after Fukushima, even though it only extended its reactors about 6 months before that in late 2010. Germany is the most exposed to natural gas supplies in Europe, and it does plan to get out of nuclear as well. So, what we might see, probably will see, is rising natural gas prices. Low prices over the last 20 years is one of the big reasons why some nuclear power plants have closed in the US. So, these are some of my thoughts, but I do urge your listeners, our viewers today, to join us on Wednesday for a very timely keynote talk by industry geopolitical expert Anna Bridza of UXC.
Yeah, well, thank you for trying to go through that. I know it's a really quickly changing situation and maybe more questions than answers at this time. If we look over to supply a little bit more broadly, we do still have major operations that are either offline or underproducing. So I want to ask, at what point you think we might see some of these mines start back up? And then even beyond that, what type of supply response do we need to see in order to meet the demand that's coming?
Yeah, so, I do think mine response will largely depend on underlying uranium prices. There is a production gap right now. I'm going to estimate maybe 40 million pounds a year. We've got demand of 177 to 180 million pounds used by utilities, where mine production, it's on the rise. It's about 135, 140 million pounds right now. The gap there has been supported by secondary supplies, and those really are anticipated to decline from sort of the 40 to 50 million pound range to about 25 to 30 million pounds per year. Underfeeding is less available as enrichment capacity has declined. Plus, as demand for enrichment services increase, less capacity is available as well. So, and then you also expect government supplies to become even more strategic, held for local requirements, as opposed to perhaps hitting the markets. But maybe back to the mine supply question here. A couple of weeks ago, Cameco said it would start the McArthur mine. McArthur River mine, but at a lower production rate, and it would trim Cigar Lake production as well. There might be room to ramp these back up to levels that we saw before 2016. World leading Kazakh uranium production did rise 12% last year. We believe that could go more, but certainly at a cost and with some challenges as well. China certainly ramping its share of production. Rossing production has rebounded since they bought it. But we do have closures in Australia, Niger, Cameco that we mentioned earlier. But there are several past producers that are currently looking to resume operations. This includes Langer Heinrich, Calcara, Honeymoon, Rosita, and Lanson in the US, other mines in the US as well. New near-term production might also include the DASA project in Niger that just broke ground last week.
Okay, so we've talked about a lot on the supply and demand side, and I wondered if now we can take a look at prices. If you put together all of these different aspects of the market that we've been talking about, what do you see coming for uranium prices in 2022?
Okay, so uranium's trading at 47 bucks a pound spot right now. Our forecast for this year is 45 bucks. So we're a little bit above that. Next year, our target, our forecast is 50, then 55 in 2024, and then 60 really for beyond that. So we believe that the price deck is reasonable in the normal world, and this provides enough incentive for new production. However, I do think given this local spat, geopolitical uncertainty, perhaps another binge by Sprott in the physical buying with security of supply overtones, we might see some risk premiums getting built into the commodity price, especially as the utilities start coming in. So I don't think we've seen that directly yet, only indirectly through recent buying through Sprott, because obviously their investors are worried about it. So we could see prices surpass 50 bucks a pound in the short term, in my opinion.
Okay, and of course, for investors, they want to know how they can get exposure to this market. And we've talked about the Sprott Trust, but I wondered if we could also look at companies and find out what characteristics you want to see when you're evaluating stocks in the space, as well as things that you might consider a red flag.
Okay, so you can break down the sector into sort of four subsections, producers, developers, explorers, like most commodities, and then associated firms. In that final group, you'd probably have the physical holders like, used to be uranium participation. Sprott's the big one now. Yellowcake is another one. You've got some uranium royalty companies, other companies that are really focused on project consolidation. So, some of what investors are looking for really depends on what kind of segment they have interest in. For producers, really management is key. They're looking for cash flow. You assume they have competent operating staff. Long-term contracts are important, cost control, reserve replacement, the typical things that you'd expect from a producer. On the developer side, obviously management skill sets are very important. They need operating, development, permitting, financing skill sets. I think the quality of the project is paramount at that stage. Social license can't be overlooked, especially in uranium. That's very, very important. Once you get down to the explorers, you are looking for teams that have technical expertise, preferably in uranium. That's important. Uranium is common, but really finding it in economic quantities is a challenge. So you need companies that can employ various exploration techniques, namely geophysical methods, put boots on the ground. Uranium investors particularly keen on seeking high-grade uranium discoveries. We've got several companies under coverage here. We follow about 23 uranium companies. 12 of those I'd consider junior explorers. For the last 15 years, I've really suggested to investors buy a basket of these juniors. You want wide exposure because you don't really know who's going to make that next discovery. A lot of the value driven value is in the early stages of the discovery. So I often look for unique companies, looking in areas that are either unexplored or maybe utilizing different or new exploration techniques. In the Athabasca Basin in Canada, for example, these are high-grade deposits, but over the last decade, I think more and more focus has been on basement-hosted deposits that may or may not be on electromagnetic conductors or EM conductors. So, most prior production before that, they were looking for unconformity deposits, right at the unconformity contact. So the drill holes didn't typically go deep enough, and they were really only testing the conductors. So, I think these ideas are changing, and that's sort of what I'm looking for in a management team. You did mention red flag. I think, things the companies must have, certainly people, geological potential, plenty of land, good jurisdiction. Social license is very important. And I think that plan, how are they going about look for something geologically? How are they going to find it? Like exploration for exploration's sake just doesn't cut it. On the red flag side, just lack of communication, whether with investors or local communities or other stakeholders. Sometimes that's just that's poison. You need a company that, without being overly promotional, can really outline its plans, what it wants to do, how everyone can participate and benefit, and then execute on those plans.
Okay, that's very helpful. And as we're getting closer to the end now, I wanted to ask if you have any specific stock picks that you would want to share, or alternatively, if you want to talk about any areas of the market where you see potential, whether that's the size of the company, geographical area, that kind of thing.
Yeah, great. I do like good jurisdictions. I don't typically sway too far afield. This could be either from production areas such as the Athabasca Basin, West US, Southwest US, Niger. But also, I do like looking at some new potential areas such as Labrador. Look there for some exploration growth. Red Cloud Securities, our top producer pick, I would say, would be Energy Fuels. I like the ability of Energy Fuels to ramp up quickly, given that it's got 3 ISR facilities, excuse me, and the only conventional mill in the USA. Plus, it's actually looking to do some rare earth production as well. On the developer side of things, I'd say our picks, we're looking at Next Gen Energy. They continue to permit and develop the Arrow deposit, and what we think is probably the world's best uranium deposit, hands down. I think that one's going to be a big producer for many, many years. Encore Energy, they host about over 170 million pounds of current historical resources just in the US. They're looking at low capital restarts at its Rosita and maybe even its Kingsville Dome ISR plants. So that one's a good one to look at. Something timely here as well, Global Atomic. They just broke ground on the DASA project in Niger. This is one where it's very high grade for outside of the basin. We're looking at 0.6, 0.7%, and they've actually got the ability to take development ore and deliver it to Orano to help them get some near-term cash flow and pay for the processing plant that they're going to want to build there as soon as possible as well. Consolidated Uranium, they're preparing 3 past producing mines for production in the US as well. That along with help from Energy Fuels, who they've got a toll milling agreement with. And that's unique in the sector. Nobody else is toll milling through Energy Fuels at all. So on the exploration side, I'd say we've got a couple picks here. Valor Metals is really refocusing on its 43 million pounds of high grade and Nunavut. This is one of the highest grade resources outside of the Athabasca Basin as well, about 0.7%. In the basin, we've got Sky Harbor and Baseload Energy. Both of those companies appear to be on some high grade basement mineralization. And then, I talked about Labrador earlier. Labrador Uranium is a company that's going to be listing momentarily as it becomes a new explorer in the very prolific central mineral belt of Labrador. There's already some pretty big mines or projects in Labrador.
Okay, perfect. So many options for everybody to consider. Now, just as a final question, I wonder if there's any other thoughts that you would want to share on uranium heading into 2022 that we didn't cover yet.
Yeah, I don't know if we haven't covered it yet, but I do think that last year was a year for physical demand. I do think that theme is going to continue this year as well, but security of supply is really going to become paramount. I think utilities are going to get it. They're going to fear volatility. They're going to fear inflation as well. And I think they're going to start coming to market. And like I've said for years, I think we need to get back to contracting. We said it earlier today. That is really going to sustain long-term pricing in the uranium sector.
Okay, well, David, thank you so much for being here to talk about what's going on in uranium. It was great to have you, and hopefully everybody will be able to tune into the Red Cloud event later this week. We'll leave the link in the video description below so people can find it. Thanks again.
My pleasure, Charlotte. Thank you very much.
Great. And once again, I'm Charlotte McLeod with the Investing News Network, and this is David Talbot with Red Cloud.